Welcome to Yahoo Finance and welcome to a live episode of the Opening Bid podcast. I'm Yahoo Finance Executive Editor Brian Sozzi, and normally we tape this big, beautiful podcast from the NASDAQ market site in Times Square, but today we have something special. We are coming to you live from our second annual Invest Conference at Second in New York City. I am so jacked up about this conference. I got absolutely zero sleep. We got Brian Moynihan on tap. We got Mark Rowan, the CEO of Apollo, on tap. Amazing guests, but for right now, we're going to bring some of these conversations to life and really dig into euphoric markets. That includes Tesla ripping to new highs, crypto touching close to 90,000 with two friends of the show, Saira Malik, President of Nuveen Equities and Fixed Income and Chief Investment Officer, and Nela Richardson, another friend of the show, Chief Economist and ESG Officer at ADP. Good to see you.
Nice.
It feels like a football program here, like bringing this to life. I wish everybody to start clapping around me. So good to see you guys. Welcome to Invest. I want to start with you, Saira, because we are seeing full-on euphoria in these markets in the wake of the election. What is going on?
Well, Brian, I think if the Trump trade and the meme stock mania had a baby, that would be what we saw in the past week. But what are we focusing on? Well, everyone's thinking about taxes, tariffs, and regulations, and what does that mean for the economy and the market? So I think three things to think about. The deficit, what does it mean for the economy? What does it mean for inflation? So first of all, it is concerning as to how much spending is going to go on next year, and will that blow out the deficit? Also for the economy, could all of these policies in place lead to an overheating economy? And what does it mean for inflation? From a portfolio point of view, though, what we're looking at in terms of portfolio positioning is, first of all, the Fed. I think the Fed, because of the strength of the economy and potential sticky to accelerating inflation, the Fed's going to cut rates less than the market expects. The market thinks one more rate cut in December for next year. We think we're going to be lower than that when all is said and done. Second, market's going to broaden. It's been broadening since July. Tech stocks have moved a little bit more out of favor. They've moved even more out of favor in the last weeks. I think the broader market's going to be picking up the slack. So those are two key factors that we're thinking about. And then finally, valuations. Let's talk about that. Where do we go from here? S&P 500 trading at about 22 times forward PE.
Seems expensive.
It does. When you think about the last time in the last quarter century when it traded higher, in March 2020, it traded at 24 times PE. The S&P is expensive, but markets don't die of old age. We need a catalyst to take this market down. We don't really have that catalyst at this point.
Neil, we joked off camera, like, I don't know, is the economy growing like 8% next year? No, but like the market, it feels like the market is ready and now expecting like great things from an economic standpoint next year. In the wake of the election, I mean, as an economist, have you raised your GDP forecast? You're expecting a consumer spending boom, like debunk a little bit what the market is expecting.
You know, we started off, Brian, and good morning. Good morning, Sarah. We started off talking about, this is kind of feels like a football energy to it, and I've been following football quite a bit. Go Hoosiers, undefeated. Anyway, the fundamentals of the economy are fantastic. It's not a perfect economy, and we can drill down on why it's not perfect, but it's really good. If you look across, if you're looking at the fundamentals, what are you seeing? You're seeing pretty low maintained unemployment. You're seeing that firms are hiring. Let's put this October report aside. After a malaise through the summer in hiring, we saw a pickup at ADP in September, a pickup in October, all firm sizes participating in this resurgence in hiring after we got some certainty. I think that certainty is a game changer. What firms were waiting on is a bit of clarity. And they've received it. They received it from the election definitively, decisively. We expected this decision to take a few weeks.
Hey, we got a winner.
We got a person.
Yeah, a person.
And we saw that the Fed was committed to continuing these rate cuts. So those two pieces of an uncertain picture were now clarified, and I think that boosted the markets more than anything. It's the certainty and the fundamentals together.
Are you confident, though, that as potentially, I say potentially because that's what the market is trading on here, that we get an acceleration in the economy next year?
No.
No.
There is no foregone. We're not even
that.
confident, honestly, given what we're seeing in services inflation, given what we're seeing in this resurgence of hiring. There is no confidence that even inflation will continue to trend down in a straight line. It's going to be a bumpy path. That last mile, those last few inches towards the goal are sometimes the toughest, and I think that's what you're going to see in 2025 as you look around the world and pockets of inflationary trends that could feed back into the U.S. economy.
How big a risk is that, Saira, to the investment thesis here? The market is asset values are reflating, but if we get a reflation in the economy, you don't get those Fed rate cuts, then does that blow up the Trump trade?
I think the last mile of inflation is the key risk for 2025, and you are seeing inflation expectations pick up. University of Michigan inflation expectations has picked up to, on the one-year basis, 2.6%, 5 to 10-year, 3.1%. People are concerned that these policies of more spending, tax cuts, tariffs are going to lead to greater inflation. And then the flip side of that, Nela brought up a couple of good points. One was that markets hate uncertainty, so what they're happy about post last Tuesday is that we have certainty and we got it quickly, but also talking about payrolls. October payrolls, hopefully an anomaly coming in at plus 12,000, but it also shows that perhaps September payrolls, which were a little over 250,000, were also an anomaly. So where are the employment markets right now, and what does that mean? Because if you're going to have a bit of a pickup in inflation, we need the U.S. economy to hold up. Employment and consumers have been holding up the U.S. economy. If both of those don't stay where they are or at levels that are expansionary, then we could have an issue and start talking about that word we all hate to talk about, which is stagflation.
You think we're in a what's the potential for a stagflationary environment?
Not seeing it yet. I mean, this economy has been characterized in so many ways. Soft landing, hard landing, recession, stagflation.
Well, I love writing about stagflation because, people, they see the word, they're like, oh, I don't know, sounds interesting. I don't know, let's click through.
It's a word we haven't talked about in a few weeks, so let's choose that one.
Absolutely.
But if you look at actual fundamentals, you'll see that hiring is still strong. And like Saira mentioned, it's supporting really robust and resilient consumer spending. I think this economy has landed. I think it landed like last year. We're just sitting on the tarmac at Newark Airport waiting for the all clear.
Nobody wants to be at Newark. Sorry, Newark. Like, nobody likes your airport. Like, nobody.
Those are your words.
No, it's fair. No, it's fair. I'll take the heat.
But there is a sense that this economy has landed, that inflation has come down tremendously close to the Fed target. Now, that last mile is important, but as long as we can sustain steady hiring and an employed consumer, then we're good to go for 2025. And if you look at other pieces of data besides that, I think hurricane and strike affected October BLS release, what will you see? You'll see that jobless claims are still really, really low. Not just low for now, they're low historically. If you look at ADP data, we pay 1 in 6 workers in the United States, strong, robust hiring there. Where you see weakness is manufacturing. And that is a cause for concern because manufacturing is very cyclical. That industry should benefit the most from rate cuts. The fact that it isn't yet is a problem, and I think that's a systemic structural problem, not something that the Fed can help with.
We've got a lot of cool people that are going to be at this event, but a lot of them will be the average investor. I mean, that is the Yahoo Finance community. And they're going to come in here, they're going to enjoy their time, but they're going to go back home and they still see prices for stuff high. They'll go to the grocery store, eggs are still high, cereal prices still high. Like, why is inflation maybe not coming down to the extent some of these folks would think?
2 reasons. And yes, we have a grumpy consumer that's still spending. And the reason why is that as economists, we focus on rates. We love rates. Rates come down. But as a consumer, even I as an economist walk into a store and say, man.
Like, when did cereal become like $8 a box? And it's like less cereal in the box. It's like this.
It's where are these prices coming from? Yeah. I immediately stop being an economist and start being a consumer. And yes, I'm mad about the box of cereal. It's $8, exactly. But also from the labor market's perspective, real wages haven't grown all that long. And so the consumer has been missing out on real wage gains. Even though wage growth was high, inflation was higher. And so we haven't had a consumer that's really benefited from real wage growth to make up for what they lost when we were coming out of the high inflation period. So that's the issue.
Saira, do you think, can the Fed cut rates while cereal prices are still $8? I mean, I'm just putting in like super simple terms, but they've cut rates now a couple times. Do they risk sowing the seeds of more inflation, and then they have to stop and the market just gets all chaotic in the middle of next year?
Well, I think first of all, just touching on the consumer, which Nela talked about, the strength of the consumer has been tilted to the high-end consumer. So I think that's another, under the surface, what we need to think about is that some of the lower-end consumer, they have been really impacted more so than other areas. That's one area to think about also. I think that that's going to be the Fed's conundrum, is that this last mile of inflation is staying between probably 2 and 3% for the foreseeable future, yet the markets want the Fed to cut rates 5 times. How do we do that? I think that's where we're going to run into an issue, and we're going to see less Fed rate cuts than the market wants, which has been a theme for this entire cycle. Remember, beginning of this year, we came in expecting 7 equivalent of 7 rate
That was
cuts.
a Davos. I'm like, wow, we're getting like 7 rate cuts. It was like, well, no, it's not happening.
So, I mean, we'll be lucky if we'll get 3 to 4 in the end. And what are we going to get next year? I don't think we are going to get 4 because of the issue of inflation. And secondarily, as we've talked about, the economy remains quite strong. So that's not an era for the Fed to cut rates. And we're already seeing with this sort of easy monetary fiscal policy what's happening with the markets, which is also creating a wealth effect. There's just a lot of liquidity already out there in the system. And in some way, we're going to have to probably pull that back a bit, or we're going to keep moving into what could be called a bubble territory.
Saira, as someone that oversees a large sum of money, where do you stand on, it could be a rocky year for the Federal Reserve and Jerome Powell. The president comes in, maybe he critiques Powell again, but like how important is that for you that the Fed is a true independent institution?
I mean, I think it is important for the Fed to act independently in their battle. And I also think a lot of the risk now is going to shift to the Fed. And what do they do in terms of managing rate cuts in order to finally get inflation to where consumers and the economy needs it to be? And can they do that while keeping the economy strong? And that gets back to soft landing, hard landing, no landing. Where are we in this cycle is all going to be very important. What we're looking at is, I think, first of all, for large asset managers, what we've seen starting in early July, there was a shift away from technology. So roll into, let's go backwards, Feb 2023. That's when the AI trade became, very well known. Those stocks took off. They basically drove the markets until early July 2024. And since then, we have seen this broadening out of the market to other sectors. And then with the expectation for Trump winning, markets became even broader. Now the meme stocks are participating. So for large asset managers, we need to be able to position outside of growth into more cyclicals and also make sure that we're well positioned across defensive stocks in case the economy does start to slow down. So those are the kind of things we've been thinking about, staying higher quality for when or if that recession comes, and if rates stay high and companies with large debt burdens on their balance sheets start to struggle.
Hang with us. We're going to go off for a quick break because we got to pay those bills. We'll be right back here on Opening Bid live from the Invest Conference. All right, welcome back to Yahoo Finance and a live episode of the Opening Bid podcast. I'm Yahoo Finance Executive Editor Brian Sozzi, coming to you live from our second annual Invest Conference here in New York City at Second. So jazzed about the lineup and the programming we are about to bring to you. Also jazzed about this conversation we've been having on stocks and the economy with Saira Malik and Nela Richardson. And then, Neil, let me go back to you. How should an investor think about the Trump economy in 2025? How will it be defined?
I think it's, first of all, Brian, important to reset all of your assumptions about what works and what doesn't work in the economy and follow the data. Now, we can criticize the Fed at times for being maybe too data dependent, but where they haven't gone wrong is how anchored they have been on the here and now and what's happening in the economy. Investors like to project. That's how they make money. Right, Sarah? But in this economy, it's really important to follow the data. Look at the labor market. Understand what the consumer is. When it comes to policy moves, look at the fine print over the macro policy. If you're thinking through different scenarios on tariffs, and scenario analysis is going to be really important, look at the product exclusion list, not just the policy, because that's going to complete the picture for you. If you're a retail investor, focus on the consumer. It's your most important data point. There's going to be a lot said in the news media, there's going to be a lot said with the policy, but the consumer never bends the truth. The consumer always knows what the consumer's position is, and if the consumer is still spending, that means the economy is still strong.
Can government, though, a new administration, can they enact change quick enough you go from economy, like you were talking about, that's not perfect, and you have a market now expecting that it, at some point, does hit perfect levels next year? I mean, is it mid-year 2025, or it takes a year or two?
I'm going to make a prediction.
Okay.
The economy will never be perfect.
Will never be perfect. Okay. I'm trying to be hopeful.
You heard it here
I'm
first,
trying to be
Brian.
hopeful. Okay. That's going to be one of the headlines. It will not be perfect.
But there's going to be places of strength, and you have to look at those places. We've seen generative AI take over the consumer imagination, at least in my house, and stocks have rallied on that. If that's a place of strength, then you have at least a direction to watch going into next year. I've said that manufacturing has been weak. What role is manufacturing playing in your overall portfolio? Because you want a little bit of that. But how manufacturing fares in 2025 will be the test of policy. because it was weak going into the pandemic. It's been weak coming out of the pandemic. It's critical in terms of American overall strength long term. If manufacturing turns around, then that would be a big game changer for the U.S. economy over the long term, not just the short term.
I'm going to make fun of myself here, Saira. I hate when I ask, are we in a bubble? Because I sound like a clown. I'll ask it. I have no other way to ask it. I mean, are we seeing a bubble happen in markets based on assumptions to the economy that may not happen?
Well, first of all, I'm glad you're no longer asking me about cereal because you were making me you're making me hungry for
these prices are low.
For my favorite cereal, which was Fruit Loops, by the way,
Really?
when I was a
Fruit
kid. I love them.
That's a close second to mine.
I'm a rice chest guy. I'm a rice chest
What were you? I was all for the sugar. If you look at valuations, we talked about this a little earlier. S&P at 22 times. Go back a quarter century, you're going to find a higher valuation one time in March 2020 when it was 24 times. So the valuations, you might argue, were in a bubble. But there's a lot of differences from the late 90s to today. In the late 90s, I was a small cap growth portfolio manager, so I remember it well. Almost have PTSD from it. Tech stocks were a lot different back then. They were unprofitable. They didn't really have a proper growth path. AI is here to stay. The mega cap 7 companies are obviously very profitable, strong growers, structural growth going forward. I don't think it's a tech bubble. Talking about other areas of the market that have worked in the last week, small caps, banks, crypto.
Banks have been on fire.
And these are, again, none of these, looking at small caps and banks where, areas that we're invested, these are fundamentally strong companies. Small caps are still trading at about a 2-decade low versus large caps. So no way would you say those are expensive, and they have a lot of tailwinds now with lower taxes, lower interest rates, which is good for their debt burdens, and tariffs, which is better for domestically oriented companies, of which small caps have more of a domestic profile than large caps do. Banks, same thing. Easier regulations for banks should make banks stronger and have better growth going forward. So these areas that are on fire in the last week are certainly not in bubble territory. So barring valuations, and as I said earlier, bull markets don't die of old age, I don't think we are in bubble territory. I think this is a market that still in the near term has upside unless we hit that inflation wall going forward.
Can you unpack what we're seeing in Tesla? I know you're not making calls on the stock, but like for the average person, what is going on to wake up on a Monday yesterday and see the stock explode? It is a $1 trillion market cap. What is the psychology behind what's happening with that?
I think there's two factors to think about with Tesla. One is the fundamentals, and second is Elon Musk's influence, within Tesla. So fundamentally, think about Tesla. The shift to electric vehicles, shift to renewable energy is a trend that's in place. It's going to remain in place. So that is for the long term, Tesla has a lot of growth trajectory in front of it. And then, of course, with Elon Musk and his relationship with Donald Trump and with the Republicans, I think there was also a lot of attention brought to Tesla, which made the stock spike. It had not been a winner year to date in general versus the other Mag 7, so it had been a laggard. This is part of a catch-up trade for the stock. And then, as I mentioned, strong long-term fundamentals and that shift to electric vehicles and more use of renewable energy is still in place for the stock. Now, with these stocks reacting so strongly in the past week or so, and what we're seeing today is them starting to settle down, and Trump, of course, not even in office yet, I think it's not going to be straight up and to the right from here on out. There's going to be a settling period, a period of churn until Trump comes in and we really see the policies and the impact of what he puts into place.
What's your view on crypto? Is it part of Nuveen? Is it something like you have to at some point be involved with if this administration becomes more friendly to digital assets? To see Bitcoin knocking on the door of $90,000. That's a huge move.
That buys a lot of cereal.
That buys a lot of cereal and maybe gets me a new car, a couple watches, but it's crazy.
First of all, looking at crypto, it's a play on easier regulations, which is positive for the currency. It's an area that we're always watching. My concern and my hesitation when looking at crypto is it can be very volatile. So similar to the volatility of equities, probably times 5. Liquidity can be an issue with crypto. So there are and fundamentals can be hard to analyze, and you've seen that with these price moves. And so it's difficult as a fundamental investor to say, okay, what's your price target on crypto? And then on top of it, if you're, for people who have cash on the sidelines, there's still trillions of cash sitting in T-bills and CDs, earning a lot less than what the equity markets are returning, which is about 25% year to date on equities. And they're trying to move their money back into the markets in a low risk way. So I think they're more thinking about fixed income, defensive, lower volatility equities than they are about, let me take my cash and put it into crypto and see how it does.
And I think these short-term trends that you're seeing maybe post-election are going to collide with the demographic changes we're already seeing in the country, right? yes, it might make sense to move from cash into stock, but you have a large contingent of retirees who want their safe and secure asset. So here's where the difference is going to become, is the long term versus the short term. And I think it's going to be exacerbated next year because so much is changing. And if I could say a little bit about the fundamentals of the U.S. economy, maybe not Tesla stock.
If you want to comment on that too, we'll take it.
But one thing we're going to see, I think, is lower, more moderate hiring going forward. That is just the aftermath of a large recovery. But I will contend that the hiring we've seen lately is more robust, even though it's been on average lower than the hiring we saw in 22, 23. That was replacement hiring. Now, when firms are hiring, it's because they want to grow their workforce, not replace it. And the hiring has been broad-based. It's not, except for manufacturing, we've seen all service sector firms participate. What that means is it's not being carried by a couple of hard-hit pandemic sectors like leisure and hospitality and healthcare. So if you're thinking about the sectorial or the industry makeup of your portfolio, having a labor market that supports widespread growth across the service sector will be a help in terms of like having this more broad-based investment plan as opposed to a few sectors that are working.
No, it's a really good point. In the final minutes that we have on opening bid, we always like to get our guests' hot takes. Maybe I think on the economy, what is your hot take or biggest prediction for the economy in 2025? What might surprise people?
But Taylor Swift doesn't make as much money in 2025 as she does in 2024.
But she's still going to power the economy, right?
Yes, several, but not as much strength as we did. I'm on the spur of the moment.
Are you a Swiftie? I mean, you're a Swiftie?
Of course, who isn't?
Neither are my kids.
Not a Swiftie. No.
You can go to the concert.
Okay, one non-Swiftie.
Okay, all right. Saira, over to you. A hot take for 2025. Maybe it's a big call on markets or sector. Whatever you got.
Well, it's interesting. The focus is nonstop on the U.S. right now, deservedly so. Not a lot of talk about non-U.S., especially unless it's about China. And are the tariffs going to be just applied to China or more broadly? What does that mean for the rest of the world?
Take up the cereal box for like $12.
What's going on with geopolitical issues, and what does that mean for the markets? I think a lot of that is sort of getting pushed to the wayside right now, and it's going to become very important, and it still is important as of today. Maybe two more hot takes will just be on. I mentioned small caps, one of our top areas, given how cheap they are and given the new administration and their view. A couple of stocks that we like: Addus Home Care and Lumenum. Addus Home Care, a play on aging demographics and home health care within the house. M&A activity, which we expect to pick up in 2025, I think could be positive for them as they add on acquisitions. And Lumenum, a photonics and optical play, also is a play on AI, data centers, more telecom building in the U.S. I do think infrastructure in the U.S. will continue to grow, and that's a play on that.
I would have to add to the global picture, it's been a support for the U.S. economy. If it goes awry, it will be a headwind. So we can't write off the global sector. It's really super important to the growth in 2025.
What you want to see is our producer Ray off camera here. She loves these hot takes. These were her ideas, so she's got like 9 of them here. So I hope we gave enough to Ray. She's giving me a thumbs up. Thumbs up. There we go. Amazing. On a personal note, thank you guys both for doing this, coming to us at our Invest conference. It's early. You were both early supporters of Yahoo Finance, literally since day one we launched. And I thank you very much. Amazing conversation. Nela Richardson, Chief Economist and ESG Officer at ADP, and Saira Malik, President of Nuveen Equities and Fixed Income, and Chief Investment Officer. Big title, big responsibilities. Thank you so much. Have a great rest of the week.
Thank you, Brian.
All right, much more ahead from the Invest conference on Yahoo Finance. We'll be right back with Shauna Smith and Madison Mills going to bring you inside our big, beautiful, amazing conference. We'll be right back.